Hi, we will continue our series on strategic business planning, and today we want to cover operation strategy and financial strategy. And so, what are the key components to an operation strategy? What are the questions that you need to ask yourself and therefore answer them? Is what will you do to deliver products or services to your target market? Right? So, number one is you've defined your target market, and we took you through a framework for defining your target market. You know what your product or your services strategy is, and we've taken you through that framework. So now it is a question of, well, how are you going to connect your products and your services to your target market? What is it that you need as a business to deliver them to the promises that you've been making? And so basically, infrastructure questions. Do you want to operate as yourself, for example, or are you going to operate as a trading entity, a company, whether it's either a private company, and obviously whether it's a listed company and so forth? It depends on what it is you want to achieve and who your target market is, and I guess also who your investors are, who are the partners in the business. But answering that question is, what is the vehicle through which I want to deliver my products and my services to my target market? Very important to consider that. And so where we are pitching this is normally, in the past, we could actually incorporate a close corporation, or you could incorporate a private company, proprietary, limited. And there were different reasons for choosing either or. These days, you want to register a company, the option you have a for-profit company. Of course, the option you have is a PDY limited. You ask the question of what facilities will you need to deliver the product to your target market? What machinery or equipment will you need? How many people will you need? What information and communications technology will you need? And another question is, what can we outsource? And there's no shame in thinking through that one. You want to stick to your knitting. What is core to your ability to manufacture, deliver the product? And you look for partnership. Who has developed systems that are far more efficient than what you can design? Other questions around your operation strategy is, how and where will your products or your services will they be produced? What qualities would you need in a location? What special regulations cover your industry or profession? So if you're in the food industry, very important. If you're in the pharmaceutical industry, critical. How many employees do you need? Do they need to be skilled, unskilled, or professional? You think through all of these questions. Now, if you're already in an existing business, is that you already got an infrastructure, and you can assess and you can audit what it is you have currently. And then if you're a manufacturing company, what kind of stock will you keep? What will be the stock level? What is the minimum stock level that you will keep? What are critical stock levels? When will you replenish them? Are they locally sourced, or do you have to import them? What are the delivery lead times if you do so? And therefore that will also influence the levels that you keep. Who will be your key suppliers? Very important, because remember, key suppliers support your brand, and if they let you down, you let your customer down. So it's very important for you to consider who your suppliers are going to be. You don't just take the first come, as in first served, is that you find somebody on the internet somewhere and you start using them, but they're not really partners with you in terms of how you deliver your product, and not necessarily supporting your brand strength. Okay, so that in a nutshell is just some of the questions that you need to ask. Very basic questions around what it is your strategy is as far as operations is concerned. Bearing in mind is that marketing is all about making promises. Operations is about delivering to those promises. So your operation strategy must ensure delivery to promise. We move on now to having a financial strategy. And you can kind of say, why have a financial strategy? It's pretty simple. Open up a bank account, sell a product, money comes in, money goes out, covers expenses, there's money left, and it's divided, either given back to the business, plowed back into the business, or it goes into the back pocket of the shareholder. But the key question about having a financial strategy is how will you ensure sustainability? And sustainability is key. And so you need financial planning. One of the things is that in the core components of understanding that when we look at revenue and the size of revenue, we say is vanity. It feeds our ego, because the bigger it is, the more special we think we are, because of the revenues we tend to generate, whether it's billions, trillions, millions, multi-millions. It kind of generates that sense of that we are big boys in the block. But sanity has to prevail in terms of how profitable you actually deliver products and services to your marketplace. If you're not profitable, you're not going to be sustainable. And then what is also key within the reality check is that your cash flow needs to be healthy. So yes, you can be profitable, but if your cash flow is negative, you can also go out of business. So your sustainability depends, of course, on your revenue, depends on your profitability, but most of all is how you manage your cash flow. So you need planning for this, right? So here are things that most of you don't even have time for. Anybody listening to this is that do a monthly sales forecast. Yes, spend the time to do so. You could say, but I really am so under pressure. Well, yes. So look at basically your historical sales. Just ask your bookkeeper or your accountant to go into the package that you're using and analyze basically what your turnover has been like. Who have you been selling it to? What the prices were, and are they profitable? Do the market research. You've been selling it at a certain price. What is happening in your market, for example, that will give you opportunity to increase your sales? Or your product, in terms of its life cycle, is in a downward phase. And therefore, people are switching to alternatives. And you now know that the sales that you're expecting with that particular product is not going to be quite to expectation. So you need to think out of the box in terms of what else are you going to be providing. Has the market shifted? What are the needs? What are the new problems that you need to be meeting? And then marketing strategies. So basically, in order for you to think about how you put your sales forecast together is in the combination of what you've done up until that point in terms of your own sales performance. Then you do the market research, and then you look at basically what your marketing strategy is all about. All right, how effective are your marketing strategies that will impact on your sales forecast? The other tool is to do your 12-month profit and loss forecast. This is now based on your sales forecast. I'm going to generate this revenue, but what's the breakdown of my expenses? All right. So what sits as components in that 12-month profit and loss forecast is also your cost of sales, right? So basically, what's your monthly sales income less your cost of sale, and then less your monthly expenses, all itemized over a period of 12 months, which gives you an idea. You have certain expectations, but it gives you the opportunity to think through what you anticipate your expenses will be. Cost of goods sold or cost of sales. Very important. The more you sell, depending on what you sell, you got to factor in that there's a cost associated with the sale. If you're manufacturing, you need to buy raw materials and all those kinds of things, and you need to know what these things are. So you need to know what your gross margins are as a result, because that then needs to cover your expenses. and understand. So that when you have a forward looking, you can actually see I might have months where my profitability is not going to be up to standard for a variety of different reasons. You might be making balloon payments on expenses that's going to severely hamper your profitability. And therefore it comes to the last one, which is a cash flow forecast, which is going to influence your cash flow. So why do a cash flow forecast? Well, it is answering these questions. How much cash is needed in the business? Whether you either a startup or whether you want to continue, you want to expand, and you're in a growth phase, once again, thinking about the industry life cycle or your product life cycles. When and how much will you need to borrow? Because when you do your cash flow, you can see where you're going to have a shortfall. And when you see that shortfall, it normally, if you own your own business, whether you're going to have to inject cash into the business or whether you're going to actually require external financing. And very important. So from a cash flow perspective, if you, depending on your pricing strategy and you have terms and conditions associated with that, if you're selling on credit, for example, when do you expect to receive your money? If you're selling on a 30-day credit basis, then we all know that the very, very best is that you're going to receive payments at the 45-day mark. And so you need to factor that in your cash flow. And then, so your expectancy for receiving payment looks a certain way based on your terms and conditions of sale. And then when do you pay suppliers? Because they have terms and conditions. When are they expecting? All right, and especially with statutory expenses like banks and SARS and Department of Labor and so forth, they want it by a certain time. So you need to factor all of those things in. And by the way, how you pay your employees. Do you pay them? Most companies would pay close to the end of the month, 25th or so money can clear enough so that your employees can therefore also service and maintain their lifestyles and look after their families. The one part when it comes to financial planning, it is considering the balance sheet. Alright, so you don't even look at that balance sheet, you don't have the time, and sometimes it's just something that the accountant does and you don't really pay attention to it. But it's really important that what is critical for you to understand on that balance sheet, it is understanding what your total assets are, right? What are the items of value held by the company? You need to ask yourself. So you could have non-current assets, for example, in property, plant and equipment. And what are your current assets, right? Would be your trade and other receivables. What are trade and other receivables? Well, you have sold your goods and services to a client, and when specifically it's not a cash sale, anything that's not a cash sale is going to find its way onto your balance sheet, because there's a period in which you've got to wait. So you're extending credit, so that means the money that you expect to be paid is now a receivable. Alright, you're expecting to be paid, and that appears on your balance sheet. And then also, what is cash and cash equivalents? Cash is just money that you absolutely have in the bank, and cash equivalents is anything that any instrument that you convert very easily into money. So readily available in that way. So that all appears as your current assets. So the other components on the balance sheet would be also, what are your total liabilities? What are your company debts? Now you can also have non-current liabilities, which is all these long-term loans that your business has. And then what are your current liabilities? Which means the money that you owe to your creditors. For example, the people that are supplying you with raw materials and so forth, and you haven't, and it wasn't a cash sale, you bought it on account, but you now owe them, so they're waiting for that, and that also appears on the balance sheet. And so, quite frankly, why the balance sheet is of such great importance to you is, alright, do you own an asset of value? So what is your equity? What is your stake in this business? And literally, you got to look at what is the total assets now, which is both long-term and current, as well as what are my total liabilities, long-term and current, and the difference between the two of them. Your assets must be more than your liabilities, then you have equity in your business. Then you have an asset of it. Right, another component of the financial planning is also, have you done your break-even analysis? Meaning, have you figured out how much you must sell in order for you to cover all the expenses of the business as a minimum? So that's what it is, right? Anything beyond that break-even target is profit. But have you figured it out? It's not just, oh, I've sold 1,000 or I sold a 1,000,000 and therefore I am making money. No, you may not be making money if you're selling below your break-even point. You've got to know what your break-even point is. So what does it actually do when you do this break-even analysis? Is that you want to use it to predict the sales volume required to recover total costs, as I mentioned earlier on. And it's also the sales level that is the dividing line between operating at a loss or operating at a profit. Break it. So how do you do this? Well, the basic formula is like, to figure out break-even sales, you need to know what your fixed costs are every month. No sales, I still have to service some, costs like building, rentals, I got to pay employees, I got to pay SARS, and so on. So what are my fixed costs? And literally how you think about a fixed cost is like, okay, what is the cost left in the business without me having a sale? Right? You're going to have to carry that cost until you get a sale. Or you're going to carry that cost even if your sales are inadequate. So basically it's your fixed cost divided by your 1 minus your variable cost as a percentage. Right? So fixed cost, 1 minus your variable cost percentage. Now what is a variable cost? So you have a sale, so that means you incur the cost associated with the manufacturing of the product, whether it's raw materials, anything that you incur only when you have a sale, right? As a percentage of the sale. So if that typically is 40%, 60%, it would be 1 minus 0.6, right? Which will give you 0.4. So you have your fixed cost divided by 0.4 and it will give you your break-even sales. Alright, and just to reiterate, your fixed cost is not a percentage, your fixed cost is in rands. Alright, and only your variable cost is expressed as a percentage of sale. Thank you.